The RBI appointed Monetary Policy Committee is widely expected to maintain the status quo on the repo rate for the fourth consecutive time when it meets this Friday, October 6. The MPC stance will likely be unchanged as experts believe the recent food prices-led spike in CPI inflation has proved to be transient, with the print cooling off to 6.8% in August from the 15-month high of 7.4% in July. While surging global crude oil prices have stoked inflation fears again, weak rural demand back home is expected to keep the central bank focused on supporting growth.
It's unlikely that RBI is going to do too much in this monetary policy, despite a sharp rise in crude oil prices. India's current K-shaped recovery, where high-end consumption remains strong but rural consumption still remains very weak, cannot support significantly higher levels of interest rate movement upwards. Simply on account of weak rural consumption, we have seen also problems in terms of jobs, problems in terms of lower financial savings from households, and hence it is that very reason that India's tightening over the monetary policy has been rather slower in comparison to global tightening that we have seen, especially in the US.
That said, on the last three occasions when the RBI held rates steady between April and August this year, the domestic equity market displayed muted movement. The Nifty, for instance, declined 0.5% on the last two policy outcomes, while it edged 0.2% higher at the very first pause that came in April. Moreover, the average volatility on the Nifty has been less than 1% on all three occasions. This time too, market experts do not expect the policy outcome to evoke any significant reaction on Dalal Street, as investors are currently more focused on the fresh global uncertainty. A new narrative from overseas is emerging that interest rates could be higher for longer, so expectations of any rate cuts need to be pushed to at least Q1 FY25. Recent market volatility is already pricing uncertainty around the rate cut trajectory. Hence, the coming policy will not have any material impact on the markets, said Anil Rego of Right Horizons. Thus, while the RBI is expected to keep monetary stimulus in check by maintaining tight liquidity, the policy outcome is expected to be a non-event for domestic equities, which are currently reacting more to global worries. Today, on October 5, investors will keep an eye on the service PMI data for September and the weekly Nifty options expiry.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
He's moving from employee to employer. Business Standard.